So the next thing we're going to look at is the covered call. We didn't do this one, right? Did we? We did? Okay. Okay. Then the next one is long straddle. Okay. Okay. So in the long straddle, okay, it doesn't stop. Perfect. So what do we do is you are buying a put. Long straddle is actually very popular. You buy a put, its exercise price is 50 again. You pay $10 to buy the put. So the payoff is like this, okay? Okay, and then what you do is you are buying a call at the same time. Its exercise price is 50 and you're paying $10 for this. These are actually not payoffs, these are profits, right? It should say profits. Okay. So then what happens is, let's look at this one more time. You're buying a put, you're exercising the put when the exercise price, stock price is less than the exercise price. For call options, it's just the opposite. You buy the call, you exercise the call only when stock price is higher than the exercise price. Then together, what's going to happen to your profits? It's going to look like this, the blue one. So in this case, as you can see, this is only profitable when? When the stock price is way less than 30 or when the stock price is higher than 70. So in what case you would buy a long straddle?
Volatile?
Exactly. When you expect the market to be very volatile, you would form a long straddle. So the further away you are from the current market price, whatever it is, but it should be less than 30 and higher than 70, which is a lot of volatility, then you're going to make profit on it. So this is long straddle. Now we are going to look at the short straddle. So in this case, what you do, you're just doing the opposite thing. So you're selling a call and you're selling a put. The same condition, $50 exercise price, $10 for put, $10 for the call. So the blue line is the final diagram for the profit. So this time you're making profit when you're between 30 to 70. So it is just the opposite of long straddle. If you expect the stock market or the stock price not to be very volatile, you go with shorting. You go with short straddle. So this time you're selling a call, you're selling a put. Okay. Of course, in real world, you're paying the premiums. On top of it, you're paying commissions and stuff. So I'm talking about them as if it's very easy, you know, but it's not that easy in real world, of course. We're just looking at basics. There's strangle. This is kind of an interesting one. So it's a portfolio. When you buy a call option and put option on the same stock with the same exercise dates, but the strike price on the call will exceed the strike price on the put. Like seriously, there's a strategy and it's called strangle. Okay, so let's look at this example. You're long bought a call option and put option on HB stock with the same expiration date. The exercise price of the call option is 40. The exercise price of the put option is 30, just like what the previous slide said. Plot the payoff of the combination. Okay. So what you're doing is, here you buy a call and you exercise the call when stock price is higher than the exercise price of the call. So it is the hockey stick diagram. And then you're buying a put and you're going to exercise the put option only when the stock price is less than 30, the exercise price of the put. So do you see what happens here? So you're going to have something like this. So what did you do with this? So you're basically, I don't know, you're kind of smoothing out this part a little bit actually. So in this case, what happens is you're not making any money if the stock price is between 30 and 40, the strike price of call option and put option and call option. But on every other case, you're making money basically. So again, this is kind of a strategy when you when you think the stock price will be very volatile. Okay, so this is called strangle.
When you deduct the price of the options, I think that gap that is boundary?
When you look at profits, you say?
No, I mean, those prices are strike prices, 40 and 50.
Yes.
And you pay
The premiums, price, you pay prices.
You pay prices, and if you like deduct the prices from the strikes, that gets, I think it out.
Oh yeah, it's gonna be like this, and the other one will go down also. Yes, you're right. These are of course payoffs. Like when we look at profits, it's gonna look a little bit different. Okay, so this is triangle. Oh, there's butterfly spread. This is a cute one. So what you do is you're buying. These are real, okay? You buy 2 call options with different strike prices, and then you sell 2 call options with the strike price equal to the average strike price of the first 2 calls. Okay, it's too much. Okay, so basically, this is how it's gonna look. So what you're doing, you're buying a call for $20. Okay, so this is gonna be the diagram for it. Then you're buying a call for $40 here. And then what were we doing? And then we're selling 2 call options. And the strike price should be equal to the average of the first 2. So the average is 30. So you're selling 2 calls, which has $30 strike price. So when you play with things, it's going to look like this. It's going to look like a butterfly spread. So you're making money when the stock price is between the strike prices of 2 calls you just bought. Yes?
Why I buy 40 call? Why I do 40 call contract for 40?
Yes?
Why?
No, what do you mean? So it can be like 50, 60, it doesn't matter.
I mean, there's also 20.
Oh, okay. So why is this 40 strike price? Why is it, this is 20?
No,
So you can buy more of the $20
Yes,
one, you're saying. Okay, you can do it, but this has different risks, of course. So, and you pay different prices for it in real world. I will actually ask you to look at that later. In real world, of course, like there are lots of different types of options. We looked at Microsoft, there were like a list of things with different strike prices. Their prices was different as well. I'm going to talk about what affects prices of options maybe today or probably Thursday. Okay, so this is the butterfly spread. Oh, and we're done. So we're going to go back to calculations of stock prices and stuff. Okay. So let's look at this put call parity example. We're moving into pricing of options, but this is going to be very basic. In real world, we use Black-Scholes, but we need to understand this to understand Black-Scholes because the idea will be similar. So this case, suppose that you're buying a Citigroup stock for $45, and you buy a put option with a strike price of 40. And you pay 180 for this. And if you remember, we covered this. It was called protective put. So you buy a stock and you buy a put. Its exercise price is 40, but you're paying 180. So the total investment you do is 4680, right? 45 for the stock, 180 for the put option. Okay. I'm going slowly because this can turn into complicated examples. So let's look at the payoffs for this. For different stock prices, what are the put values? Strike price is 40, so you will only exercise this option, put option, whenever stock price is less than 40. So the put value will be 15 when the stock price is 25. The difference between, here you can see it, put value is the difference between the stock price and exercise price. Put value is 10 when the stock price is 30, and blah, blah, blah. The combined value of the stock and put value is this. You have the stock, you make $25 on it. The put value is 15, so together the combined value is 40. So in each case, you can calculate it. Just add one row, one column to the other one. Any questions here? Any questions here? Okay. So what is your total gain or loss? So basically combined value is 40. Your initial investment is 46.8. So you're losing $6.8 in those cases. And then you started making money. So you're comparing the combined value of your investment with how much you spent. Right? So here, the total value of buying a stock and the put option gives you $65. And for this one, you spent 46.8. So you're making $18.20. Is this part clear? Baris, is it clear? Okay. Let's continue. Now I'm going to mimic this portfolio with something else. So this time, suppose that you're buying a call option. Its exercise price is 40, but you're paying $7.78 for it. Why? Because I picked it so. Okay, I'm trying to make the total gain and loss the same. And this is important. Whatever the money left you have $46.80. You bought a call option for $7.78. The remaining money will be put in treasury bills. And the interest on treasury bill is 2.5%. So at the expiration, what's going to happen? You're going to exercise the call option only when stock price is higher than the exercise price. So this part is when your call is valuable. And for the treasury bill, you're investing $39.02 in treasury bill with 2.5% interest rate. So after one period, the money you're going to have will be 40, right? Basic time value of money. 39.02 with 2.5% interest rate after one period will be equal to 40. Again, I calculate the combined values of the call and treasury bills. Add those two columns up. That's it. And again, I'm looking at my total gain or loss. I'm starting with 46.80. So I'm comparing my combined value with this. It's not a surprise that the total gain loss part is same for this strategy and this strategy, right? Almost exactly the same. So if I'm offering you two investment opportunities with same outcomes, what can you say about the prices you paid for those two investments? They should be the same, right? Low of one price. If you have same return from two investments, you should pay the same amount. So this is what a put-call parity is. So the first one was buying the stock and buying a put. The second one, it was buying a call and invest money in treasury bills. So together, this equation should be satisfied because they're giving you the same loss and gain. So this is called put-call parity. Any questions on this?
Can I ask something?
Yes.
Previous question. Where did we get the 46.8?
Oh, I'm just trying to make the investment equal. So in this one, you buy the stock for 45 and put for 180. So together you spend 46.80. So in this one, I said the call premium is 778. The remaining money is 46.8 minus 778 should be invested in treasury bills. So I'm making the same investment and I'm getting the same return from each of those investments. So they need to be equal. Anything else? Okay. So again, let's look at the graphical representation of the same thing. You can think that as bond or treasury bill, whatever. It's same. Or put it in the bank at a risk-free rate, the same. Okay. So you have the bond, and this is the payoff from the bond. You are getting 40 fixed rate from the bond, and then you bought a call. In that example, with the strike price is 40. Here, this is how the portfolio payoff will look like. Okay. Hockey stick diagram, but now because of the bonds, the payoffs increased a little bit. And if you look at the value of the portfolio today, there is the price you paid for the call option, and then this is how much investment you did. Just like in the 3902 amount of money you put for treasury bonds. Okay, so you're getting 40 from the bond. So you're gonna discount it by the interest rate. You're done. So this is the value of the portfolio today. If you look at the other option, what you were doing is, if you remember, you buy a stock. So the green one is buying a stock. Then you buy a call. Buy a put. So together, the payoff, the stick will look like this, which is exactly what we said in the previous graph. So the value of the portfolio today is the price you paid for the put plus the stock price. So basically, according to put-call parity, if there are two things with the same payoffs, the values of the portfolios should be the same today. So you can buy a put, buy a stock, which will be equal to buying a call, and the present value of your investment in the risk-free, whatever investment is, treasury bill, bank, at the risk-free rate, it's the same thing. So this is called put-call parity. Let's look at this example. You want to buy a 1-year call option and a put option on Dell. The strike price for each is $15. The current price for Dell is $14.79. Risk-free rate is 2.5%. The price of each call is $2.23. So using put-call parity, what should be the price of each put? So let's write down the equation. We're going to see the answer in the next slide. So what was the strategy? You buy a put, you buy the stock, which will be equal to buying a call and the present value of money you put in the bond. You put in the risk-free rate. So here, what was the stock price? $14.79. We don't know the price of the put. So what you do is, this 15 is the strike price for the call, or for the put is 15. So you're discounting it by the 2.5% discount rate. It's 1 period rate. I mean, we can make this question harder. We can change the time periods and stuff. But here you have 1 period. You have the annual interest rate anyway. And this one was what? This is the price of the call. So from this equation, the price of the put should be 2.07 from put-call parity. Simple. Can be made complicated, but the idea is simple. Okay, if the stock pays a dividend, you need to modify the equation a little bit. This time, you need to consider the present value of dividend as well. Because of there's the stock value, but because of the call and stock, there's dividend payments as well. So the only thing you need to do is you add the present value of the dividend payments to the right-hand side of the equation. And let's look at the same question, but now suppose that Dell is paying $1 dividend next year. So how it's going to affect the price of puts? So this time here, there's $1 dividend payment. You're discounting it by the risk-free rate again. So this time price of the put should be equal to $305. So in real world, there are dividend payments. You need to consider it as well. Again, those dividend payments depends on how many periods you're going to hold the stock for, or what is the expiration date of the call. Yes?
By being in the long position for call options, will you get the dividends? Do you receive the dividends, or?
No.
So shouldn't the...
So you buy the call, right?
Yes.
Okay, but from the stock you're getting the dividend. The price you're paying on the left-hand side, dividend you're getting actually. So there's a negative relationship, right? Right? So this is the price you paid for the stock. This is the price you paid for the put. But this is a positive thing for you. That's why you can do minus dividends actually here. You need to be consistent. Did you understand what I just said? Okay, here this is money you're paying actually. It's getting out of the pocket. You pay this to buy the stock. You pay this to buy the put. You pay this to buy the call. This is the money, the worth of money you have in the bank or in bonds, let's say. So this is the dividend you're actually getting. So it's a positive thing for you. So they should be in the opposite sides. Negative, positive thing. That's it. Okay, so this is what you should do when you have dividend payments. And Should I? Yes. Let's continue. So basically in the last section, we look at the value of the option at the expiration. But actually, we should have an idea about the value of the options before the expiration date. Because you have the right to exercise the option before the expiration date. So let's look at this. So the thing I wrote on the board is the intrinsic value, the fair value of the option. So for the call, it is the maximum of the difference between exercise price or stock price or 0. For put option, it is similar. That you're gonna get the difference between, again, exercise price and stock option or 0. But there's also the speculative value on top of it, which is actually the difference between the price of the option and the intrinsic value of the option. You're not exactly paying or getting the intrinsic value of the call. There are lots of speculative things going on with options. So let's look at this, for instance. So this is what happens when you buy a call. But because, and this is the part when the call is in the money. This is the part when the option is out of the money. So if you look at the value of the call, it should actually be between two things. It cannot be less than the intrinsic value, and it cannot be higher than the stock price. Does it make sense? Like the maximum you're gonna pay for a call option is probably the true stock price, right? We're talking about call premium. So you should see the value of the call in between. And the difference here actually, so this is the intrinsic value of the call, what we have on the board. But actually the true value might be higher than that. And this is because of the speculations or time value of the bond. So what am I trying to say? Let's see it in this example. We are looking at an American call that you can exercise before the expiration date. Stock price is 60, exercise price is 50. What is the minimum call premium? This is what we're going to look at. The maximum call premium is what? 60 stock price. But what is the minimum? So suppose that this option sells at $9. So what happens? You buy the option for $9 today. And suppose that you're exercising the call today as well. Okay? And then, which makes sense, right? Stock price is 60, exercise price is 50. You can exercise the call. And then after exercising the call today at 50, you can sell the stock at the market for 60. So what happens? You made $1. So there's an arbitrage here. So in a well-functioning market, can we have any arbitrage? No. So this opportunity will actually increase the option price, option premium, and it's going to increase it to at least 10. So 10 is, if you remember, is the difference between stock price and exercise price. It is the intrinsic value of the option. Can it be higher than 10?
Why not?
Why not? It can be 12. How can it be 12? Why not is good, but you need to support it with some explanation.
If the stock price is under.
Okay, so let's do this. Today after the class, just write a 1-2 sentence explanation to this. What is the time premium if the option sold for 12? Time premium, if you remember, is the difference between the option premium and the intrinsic value. Intrinsic value is 10. You don't have any problems with it. So what is the time premium? So it's a bonus thing. If you just write me a few sentences explanation, I'm going to open it on forum on Moodle. It's going to be like a bonus assignment. Okay? Just think about it. Okay, so this is the difference between intrinsic value and call premium is the time premium. And you're going to write on the forum why people might spend more than 10 on this call option.
Can you repeat what is the time premium?
So basically I say, you all agree that intrinsic value of the option is 10, right?
If the price is
No. Like for this option, the intrinsic value should be 10, right? But people might spend more than 10 on this option. They might spend $12 for a $10 intrinsic value option. It's called time premium or speculative premium. Why would people do that? That's the question. Why would you spend $12 on a $10 option? Okay.
What is the expiration date? Like the same as the question today. You buy today and the option expires.
Just write it down. So what happens if the expiration date is today or after 1 month? Write it down. Okay. So
Can I say something about the last question?
yes,
In the question you said that this is the American call,
yes.
so you can sell the bond before the expect.
Yeah, that's why you can sell it today.
No, no, yes. But
So expiration date might be
No, I will say something
after
about
2 months.
after.
Mhm.
You can sell after.
Not after. I mean, from today.
Okay.
Yeah, you can sell this. You can exercise this anytime before the expiration date. Is the American call.
So if you sell before, the time premium will be more in the graph.
Oh, this is what you're saying?
Yes.
But this has nothing to do with the expiration.
No, for example, the red line is the real value.
Yes.
So if you sell your bond before the
But this is all about, this has nothing to do with the expiration date, right? This is all about stock price and exercise price. This doesn't tell you anything about expiration
there
date.
is no relation between red line and the green line.
Yes, there is.
Time value. This is not time value stuff.
Okay, this is the time value, but it has nothing to do with when you exercise the call option. Tour guide?
Maybe because of
No, don't say it. You're answering my question? Don't. We're gonna write it on forum. Don't you want to get points? Like, okay, just write it down. Bless you. Okay. Last couple of things I want to do is I want to look at determinants of option values. So this is related to this one actually. So now we know that the value, the price of the call should be in between those two bonds. The maximum is the stock price, the minimum is the intrinsic value. But where we are in this area depends on different determinants. So we're going to go over those determinants, and I'm going to look at 5 different things, which kind of answers your questions, I guess. So we're going to look at how stock price, exercise price, interest rate, volatility, and expiration date affects the prices of call options and put options. And in some cases, as you can see, those determinants affect the options in a different way. So let's start with stock price. Okay. So suppose that the exercise price is 60. Stock price can be 80, or stock price can be 120. And let's look. We are looking at the call option values. So which one is better for you? Which one makes your call option more valuable? When the stock price is 80 or when the stock price is 120? You can just take the hint here. The call value is the difference between the stock price and the exercise price. So which one is better? So as you can see, whenever stock price is high, it's going to affect the call value in a positive way. And call value is the call premium actually, the intrinsic value of the call. So high stock price is better when you have a call option. How about for the put option? For put option, it's just the opposite, right? Look at the put option. It is the difference between stock price and exercise price, but in a negative way. So for the put option, when stock price is actually lower, it's a good thing for you. Because put option gives you the right to sell the stock at the predetermined number, predetermined price. So for the put option, it is just the opposite. Any questions here? Just look at the left side of the board, that's it. Okay, the second thing is the exercise price. So stock price is 60. You have call A, its exercise price is 50. Call B has an exercise price of 40. Which one is better when you look at the call option? You have a call option. Which one? Huh? Okay. This time you're gonna again you're gonna prefer the second one, which has the lowest lower exercise price because of this relationship again. So stock price is 60. So here the value of the call is 10. Here the value of the call is 20. So of course this is better. Okay. For the put option, it is just the opposite because of the same reasons. Okay. So I'm not gonna go over it for the put. Okay. The other one is the expiration date. So you have call A, an American call option. It matures in 3 months. Call B matures in 9 months. Which one do you prefer? Huh? It depends on your expectations, yes, but long time gives you more flexibility, right? More flexibility is always more valuable. So you're gonna prefer call B, which has 9 months for you. I mean, stock price can go up or down like crazy in 9 months. So actually about options now, we're gonna look at the volatility as well. More volatility, more uncertainty is a good thing when you have an option. So this will give you more time to decide on whether you want to exercise your option or not. This is true for put option and call option. Okay. Now the interest rates. Okay, so what you do is, what is important, this is more difficult to understand for students, but again, I'm going to go step by step. So when you exercise the call option, what is actually, what you're paying is you're paying the strike price, right? To buy the call option, to buy the stock, you pay the exercise price, which is strike price. The lower the present value of the strike price, the better it is for you, right? So suppose that you have this option. It's going to expire in, let's say, 1 year, which is very long, but 1 year. In 1 year, when you exercise the call option, you're going to pay the strike price, right? Because it gives you the right to buy the stock at the strike price. So whenever we're talking about the value of the option, I'm talking about today's price. Call value is call premium, what price you're going to pay. So if the strike price present value is lower, it's good for you. So this time, high interest rate is actually good for you. High interest rate makes the present value of the strike price lower today, which is a good thing for you. So let me go over this one more time, okay? It's not complicated, but you're tired. I'm tired, I understand. So you buy a call option. In all of those slides, what are we trying to do? We are trying to understand the relationship between those determinants and the call value or put value. When I say call value or put value, I'm talking about call premium and put premium. I'm talking about their intrinsic value, right? Previously, we just saw this is the intrinsic value of the call. The difference between stock price and exercise price is the intrinsic value. This is exactly what we saw in this example. The difference between the stock price and the exercise price is $10. We said this is the intrinsic value of the call. So we are actually focusing on pricing of call options or put options, whatever. So we said, what did we say? We said high stock price increases the value of the call option. Why? The higher the stock price, S minus X will be higher, so call value will be higher. Then we said, let's look at different exercise price. And we said if this exercise price is lower, then this will be higher. So call value will be higher. Call price should be higher. So we said we go with low exercise price. Then we said expiration date. The higher, the more flexibility you have, the more value the call option or put option will have. So we said long time to maturity is a good thing. The fourth thing is the interest rate. So when you buy a call, you pay the price. And when you exercise the call, you're gonna buy the stock at the exercise price when the time comes, right? I'm buying the option today at time 0. After 1 year, at the expiration date, I'm gonna exercise the call option. I'm gonna pay the exercise price. So I'm interested in the value of the call today. So I need to consider the present value of this exercise price. So why we have this relationship? Because we know that present value. So this is the strike price. So I'm interested in present value of the strike. So the higher the interest rate, this is going to be lower. So present value of the money you're going to pay will be lower, which is a good thing. So it's going to affect the call value in a positive way. For the put, who wants to explain it for the put option? For the put, you're selling the stock at the exercise price. So since you're selling the stock at the exercise price, the higher it is, the better for you. So this time, present value of the strike price should be high. And the present value of strike price will be high when the interest rate is low. So that's why we have a negative relationship for the put options. Does it make sense? For the call option, you pay the strike price to buy the stock. For the put option, you're selling the stock at the strike price. Okay, so just compare cash inflow, cash outflow. That's it. Okay, so that's the interest rate. And the last thing I want to look at is the volatility. So here I have the exercise price of 110. So I have two scenarios. In scenario 1, the stock price will be 100. In scenario 2, stock price will be 80. So what is the value of the option in that case? So if the stock price is 100, then you're going to exercise the option. The value will be 10. If the stock price is 80, oh no, it's just the opposite. Right? When are you going to exercise? When are you exercising a call option? When the stock price is high or low? Huh?
High.
Just look at this. Okay, so you're going to exercise the call when the stock price is high, higher than the exercise price. So in both cases, actually, you're not exercising it, right? They're both lower than 110 stock price. So you're not, or sorry. Can you just recap? Okay, exercise price is 110, which gives you the right to buy the stock at 110. When in the market the stock price is 100 or 80, would you exercise this? No, stock price is lower than I would just go buy from the markets, right? So in those cases, I'm not exercising it. Okay, thank you. Now I'm increasing volatility. How am I going to increase volatility? I'm going to make the outcomes more spread, right? So I'm going to have more uncertainty. So the stock price can be 120 or stock price can be 60. If the stock price is 120, would you exercise your option? Yes. If the stock price is 60, would you exercise the option? No. So what I did here is I formed two cases for you. Low volatility, high volatility case. And in both cases, the average expected price is same, right? 100 plus 80 over 2 is 90. 120 plus 60 over 2 is 90. So in both cases, your expectations on the price is 90. It's same. But this is here, the spread is lower, less uncertainty, high uncertainty. In this case, the call is not valuable. You're not exercising the call. In this case, it might be valuable when the stock price is 120. So what I'm trying to say in this whole thing is, which one is better for you? High volatility. So, I don't have. So whenever there is more volatility in the stock prices, it's good whether you have call option or put option. So more volatility affects values positively. Any questions? Okay, let's see what else do I have. Let's just go over this, and then we're going to stop, which is perfect timing. So I have two European call options. Let me read it from here. They have strike prices of 50. They are written on two different stocks. Suppose that tomorrow the low volatility stock will have a price of 50 for certain. The high volatility stock will be worth either 60 or 40, with each price having equal probability. If the exercise date of both options is tomorrow, which option will be worth more today? So without reading the answer and without doing any calculations, which one is worth more? High volatility one. Let's see whether it is really the case. So the expected value of both stocks tomorrow is 50, right? This is 50 for certain. The other one is 60 or 40. So expected price is 50. 60 or 40, equal probability. So what's going to happen? If you look at the values of the stocks, the strike price is 50. So the one with has $50 stock price for certainty will be at the money, right? Its value is 0, right? Stock price equal to the exercise price. If you look at the other one, you have 50% chance of getting 10, and you have 50% chance of losing 10. Is that correct? So if the price becomes 50, then you're making $10. If the price is 40, you're losing money, so you're not going to exercise the option, which is 0. So if you take the expected value of the worth of the thing, it's going to be 5 for the high volatility one. So the first one, certainty case, the value will be 0 at the money option. For the other one, for the high volatility one, you will either exercise it, the value will be equal to 10, or you will not exercise it, the value will be equal to 0. So expected value in this case is actually 5. So as we guessed, high volatility increase the value of the call option. So today we covered the basics of options. We look at how we can form different combinations of options. We considered put options, call options, protective puts, covered call, lots of things. And we talk about put-call parities, about the pricing of the options. And the last thing we look at how different determinants affect the price of call options and put options. So Thursday, we're going to go into more realistic world. We're going to go to binomial world. So Thursday's class will be harder for sure. Today, I went over things very slowly. If you have time, just go over the material. At least go over the slides. And I will see you on Thursday if you don't have any questions. Don't forget about the time premium thing. I'm going to make it visible on Moodle. I'm going to send you an email as long as I make it visible.
Perşembe